So, have you ever actually tried to put a price tag on a broken promise? It's tough, right? I mean, in the world of real estate, professionals are bound by some pretty strict duties of care and ethical standards. But, well, we all know that sometimes that trust fractures. The question is, how do you quantify something that feels so entirely intangible? How does a massive real estate corporation take a completely shattered relationship, a major breach of duty, or a failure of professional integrity, and translate that into cold, hard numbers on a financial statement? That is exactly what we are unpacking today.
Okay, let's dive into this because, this really isn't just about a run of bad PR or losing a single client. We're going to do a rigorous financial and legal deep dive into quantifying exactly what happens when professional loyalty fails. We're looking at the strict accounting standards that literally force corporations to lay their legal and ethical disasters bare for the whole world and, more importantly, for their investors to see.
Here is our roadmap for today's explainer. We're going to cover trust in real estate, the SASB reporting framework, navigating conflicts of interest, a deep dive into monetary losses, calculating the real cost, and finally, how actions speak louder. We'll start with the macro global standard and zoom all the way down into the micro financial metrics.
Section 1. Trust in real estate, the foundation of the industry.
Think about it. The entire real estate services business model, whether we're talking about property management, brokerage, or appraisals, is absolutely, completely dependent on client trust and loyalty. So you might be asking yourself, why on earth does a financial investor care about a dry concept like ethical risk management? Well, let's build that bridge. If a firm has inadequate risk management around things like conflicts of interest or negligence, it leads directly to regulatory fines, a total cratering of client trust, and permanently lost market share. Tracking these failures financially matters because a failure of ethics is inevitably a failure of revenue.
Section 2. The SASB reporting framework, standardizing sustainability.
If we agree that these ethical risks matter financially, we obviously need a standardized rulebook to track them. That's where the SASB standards come in. They provide a globally recognized framework for these exact types of sustainability and governance disclosures. And actually, as of August 2022, the International Sustainability Standards Board, or the ISSB, officially assumed responsibility for these standards. That makes them the ultimate authority, ensuring everyone reports on their professional integrity in a universally standardized, comparable way.
Section 3. Navigating conflicts of interest, the vulnerability of the industry.
Now, what's really interesting about this is the specific vulnerability of the industry. Brokerages and appraisal services carry an exceptionally high risk of conflicts of interest and negligence. Why? Well, simply because they often represent buyers, sellers, and property valuations all under one corporate roof. We're looking at the specific metrics required to track those vulnerabilities. You've got revenue from dual agency transactions, revenue from appraisal services, but I want to explicitly guide your eye down to that bottom metric. IF-RS-510a.3, total amount of monetary losses as a result of legal proceedings associated with professional integrity. That right there is our smoking gun.
Section 4. Deep dive into monetary losses, dissecting metric IF-RS-510a.3.
We have officially arrived at the bottom of the funnel. This is where we track the total amount of monetary losses. First, we have to understand what actually counts as a legal proceeding. And let me tell you, this net is cast incredibly wide. It isn't just about traditional lawsuits in a courtroom. It explicitly includes any adjudicative proceeding involving the entity, whether that's before a judge, a government regulator, an independent arbitrator, or otherwise. Basically, if a real estate firm is being officially penalized, it gets captured here.
And what exactly are they being penalized for? The standard gives us a categorical listing of what constitutes a breach of professional integrity. We are talking about negligence, malpractice, data security failures, fraud, corruption, and bribery. That is a severe, heavy-hitting spectrum of corporate malpractice, all grouped together because they all represent a fundamental breakdown in the duty of care owed to the client.
Section 5. Calculating the real cost. What exactly gets counted?
So, exactly how is an accountant supposed to quantify these complex legal disasters into a single line item on a balance sheet? Let's look at a high-contrast comparison. On side A, we see what is strictly included, the actual financial punishments like settlements, jury verdicts, regulatory penalties, disgorgement, and restitution. But look over at side B. What is explicitly excluded? The legal fees incurred by the entity in its own defense. So all those $1,000 an hour corporate fixers, completely 100% invisible in this specific metric.
Which brings us to a very important number, 0.
0 is exactly how much of a company's own legal defense spending is factored into this loss metric. Why? Because the SASB standards want to isolate the actual penalty from the process. Think about it. If defense costs were included, a company that fought a righteous battle and won might actually look worse on paper than a company that just quickly settled a massive fraud case. By keeping defense costs at 0, investors get a pure, unfiltered look at the actual damages incurred from professional failure.
Section 6. Actions speak louder, beyond the financial fines. So the crucial point is, the standard doesn't just stop at quantitative numbers. You can't just drop a massive multi-million-dollar loss on the balance sheet and casually walk away. There is a mandatory two-step qualitative requirement here too. Step 1, the entity must briefly describe the actual nature and context of the loss. And step 2, they must describe the corrective actions implemented in response. They have to explicitly detail to investors how they will prevent this from ever happening again. Are they overhauling operations, firing management, instituting new training, upgrading technology? They have to spill it.
Which leaves us with this final thought. We've spent this time breaking down exactly how you measured the financial cost of broken trust, but as this quote so perfectly suggests, legal fees can be paid, fines can be settled, but how long does it take to rebuild professional integrity? The SASB standard absolutely forces transparency on the balance sheet, yes, but the true, unquantifiable cost is the loss of brand value and market trust, and that is a loss that can haunt a real estate firm long after the final settlement check is cleared. Definitely something to think about the next time you're looking at a company's bottom line, right?